Welcome to the Stock Market Palantir. Today we are going to talk about IVDA. We are focusing on IVDA Solutions Incorporated, a microcap technology equity that finds itself at an extreme, and I mean a very visible, critical juncture here in November 2025.
It really is a textbook study in contradiction. I mean, it's an incredibly complex situation. You have a company defined by by navigating what looks like a financial death spiral, aggressive capital dilution, a long history of reverse splits, and, eminent regulatory non-compliance.
And that's all happening right next to this high-stakes, high-reward operational pivot. We're talking massive geopolitical implications in Egypt.
Exactly. So the central question, really what this all boils down to for anyone watching this stock, is whether IVDA's future is fundamentally determined by those structural financial headwinds, the forces of gravity pulling it down, or by the immense scale and, frankly, the sovereign potential of its strategic partnership with the Arab Organization for Industrialization, the AOI.
That is the crux of the matter. So today I'll be arguing that the structural toxicity just baked right into the capitalization table. I mean, the relentless dilution, the regulatory clock, it makes this stock fundamentally uninvestable. Regardless of how compelling this Egypt story might sound, the financial mechanics just cap any upside before it can ever be realized.
And I'm going to take the opposing view. I maintain that the current distressed valuation, trading well below any sane metric, is purely a temporary dislocation. The potential for this massive sovereign-backed operational win, it just decisively outweighs the temporary financial distress and all the market microstructure noise. For IVDA, the only path to survival is achieving massive scale with the AOI. They have to leapfrog their current problems.
Okay, let's lay out those positions clearly then. Why don't you start with your path of the great escape?
My core thesis is that the current market cap, which is hovering around, $4.66 million, isn't a reflection of the company's real operational value. It's purely a function of a ticking clock. And that clock, it strikes on November 24th, 2025. That's the hard deadline for the company to cure its NASDAQ minimum stockholders' equity requirement, a shortfall of about $2.5 million. The market is just pricing in delisting risk. But the AOI partnership, this is not just another contract. It's a strategic alliance. The AOI is a state-owned enterprise. It's deeply affiliated with the Egyptian Ministry of Military Production. This relationship, it introduces a multi-million-dollar revenue stream and completely shifts the company's reliance from, toxic financiers to a legitimate government partner.
Okay, but you have to quantify multi-million. The scale here matters.
Oh, the potential is immense. And it's geographically defined. The Egyptian CCCV and smart city market is projected to hit $582 million by 2033. By manufacturing IVDA's products, like the Waymo body cams, in-country with the AOI, the company instantly gets national product status. That status grants them preferential access to huge government tenders, like the build-out of Egypt's new administrative capital. The scale of that volume is just massive relative to IVDA's tiny size. So this pivot offers what I call the great escape. A successful execution, or critically, a massive upfront payment from the AOI that could instantaneously cure the NASDAQ equity shortfall before the deadline. The geopolitical win solves the financial problem instantly.
I see why you think that, and I agree the narrative is attractive. But let me give you a different perspective, one that's rooted in, mathematical reality. I see IVDA as a zombie company. Its equity value has been systematically just decimated by continuous financial engineering. The reliance on at-the-market or ATM offerings creates this permanent toxic supply overhang that acts like a concrete ceiling. It just caps any positive news.
You call it toxic, I'd call it necessary fuel. Without it, the company would have failed already.
But at whose expense? The ATM facility with H.C. Wainwright & Company allows the company to just drip feed millions of new shares into the market. This creates what we call rally selling. So when you have a positive announcement, say about those body cams, the buying pressure that results is immediately absorbed by the company, who is selling new supply
right into that rally to raise cash. This mechanism pretty much confirms that the market is efficiently pricing in perpetual dilution. It just kills any momentum.
So you're saying the market structure itself guarantees failure?
It guarantees failure for the common shareholder who's looking for appreciation, yes. And compounding this, you have the regulatory precipice, the attempt to solve the $2.5 million equity problem by selling shares. It just makes the bid price rule violation worse. The company is completely trapped in a regulatory catch-22. It tries to raise cash to fix one problem, which pushes the share price down, which puts it in violation of the other rule. The structural toxicity prevents the good news from ever having the impact it should.
That brings us right to our first real contention point then. The promise of this AOI payday versus the relentless drag of the ATM overhang. If the Egypt partnership is truly this transformative lifeline you suggest, why hasn't that news already lifted the stock permanently above that $1 threshold?
I agree. The lack of a sustained lift is troubling, but I think timing is everything here. These AOI contracts have long timelines, and the market, being, very short-sighted, is focused purely on that November 24th equity deadline. That's overshadowing the long-term cash flow potential.
The market microstructure tells a very different story about who is trading, though. We see persistent and substantial distribution pressure. Off-exchange short volume ratios have been consistently in the 20 to 30% range. This isn't just retail volatility. This suggests that the financing partners, the institutions who got shares through warrants or the ATM itself, they're treating positive news as their own personal liquidity events. They just monetize their positions when volume spikes. So the operational success is being converted directly into cash for the company and profit for the financiers, but never into sustained appreciation for the average shareholder.
That's an interesting point. I would frame that action differently, though. I see it as a reaction to perceived short-term insolvency risk, not a rejection of the long-term plan. But we have to look at corporate intent. The company just got shareholder approval to change its corporate domicile from Nevada to Delaware. Now, why would they take that very specific administrative step right now if the plan was just more incremental capital raises?
Why indeed? Delaware is also the preferred state for director protection against shareholder lawsuits, which might be necessary given the history here.
That's a very defensive interpretation. The more strategic one is that Delaware is the universally preferred home for companies positioning for, complex M&A or a potential acquisition. It has the most developed body of corporate case law. This signals to me that the board is actively seeking a path to value realization, an exit, perhaps through a sale to a larger entity that wants those AOI contracts.
I'm just not convinced by that. When you look at the historical context, which is fortuitous, it's just devastating. The ATM usage, the aggressive shorting. Look at the staggering 60.81% short volume spike on November 4th. That's not just volatility, that's the consequence of a broken cap table. And we cannot ignore the cumulative 1-for-64 reverse split ratio.
That's the legacy of the old structure. It's the cost of keeping the lights on.
But 1,000 shares in 2021 now holds about 15 shares. For them to break even, the stock has to appreciate by over 6,000%. That reality makes any kind of fundamental long-term investment impossible. If the board is positioning for an M&A, they're positioning for an asset sale that leaves common shareholders with, likely, little to nothing.
The fact remains, they had to make those hard choices to survive long enough for this AOI opportunity to even materialize. Now that it's here, let's focus on the microstructure stress because it offers a potential path to a rapid upside. You pointed out the failures to deliver, the FTDs, and the stock's appearance on the Reg SHO threshold list. While those are alarming, yes, their presence on that list, coupled with an extremely small public float, it suggests a coiled spring mechanism is in place.
So you're describing a classic short squeeze scenario.
Precisely. A sudden, massive, positive trigger-like confirmation of a huge AOI payment could force brokers to buy in positions to close out those FTDs. This mandatory buying pressure, focused on a tiny float, could absolutely overwhelm the ATM selling pressure, at least temporarily. It's high risk, yes, but the potential for rapid appreciation is real. and it could give them the window they need.
I'm sorry, but I just don't buy that. The squeeze scenario is low probability because the ATM acts as a constant relief valve. Whenever buying pressure builds, the ATM provides fresh supply, which just neutralizes the force of any potential short cover. It's an algorithmic cap.
I think you underestimate the psychological impact of a sudden price jump when the float is this small.
And I think you overestimate the available liquidity. More fundamentally, the stock lacks the required liquidity base to sustain a squeeze. With a market cap under $5 million, this stock is invisible to the Wall Street Bets crowd, to the viral retail traders.
So you're saying it lacks the viral liquidity needed to fight back?
Exactly. It lacks the ape army. Without that grassroots liquidity, the stock is just left vulnerable to the raw mechanics of institutional distribution. The market here isn't supported by resilient retail money. It's being suffocated by institutional selling, and the ATM is the perfect mechanism for it to continue. The squeeze requires a volume base that IVDA just does not have.
Which leads us to the final point: execution risk and the geopolitical reality of these AOI contracts. You have to concede that the financial reward, should they execute this flawlessly, is commensurate with the extreme risk involved.
I absolutely acknowledge the potential reward, but the execution risk is profound enough to negate it. This pivot to Egypt carries immense sovereign risk. Contracts with the AOI, which is part of the military-industrial complex, are notoriously opaque. Payment terms are unpredictable, and frankly, the recourse for a tiny U.S. company is almost non-existent if the Egyptian government decides to stall.
That opacity is just the nature of sovereign contracting.
But then you add the complexity of technology transfer. The deal requires transferring know-how for highly sensitive surveillance tech to Egyptian factories. This whole process adds a massive layer of complexity that must be flawlessly executed. Relying on perfection in execution in that kind of environment, it's not an investment strategy, it's a gamble.
The risk is high, yes, but the institutional guarantee is also high. The AOI is chaired by high-level government officials. This contract isn't just about selling software, it's about providing critical infrastructure for a nation-building project. And while that introduces sovereign risk, it also guarantees high-level commitment that a normal domestic contract could never match. This classifies IVDA as a unique geopolitical play, not just a standard distressed microcap.
But if the AOI deal falters, even marginally, if payments are delayed 6 months, if the tech transfer hits a snag, they burn through cash, they miss the November deadline, and they get delisted.
That is precisely why the company must push this strategy forward. They have zero alternative. Raising capital on the OTC market after a delisting would be far more difficult and expensive. The AOI deal is the company's only viable, large-scale exit strategy to solve its structural problems. Failure is fatal, but success is transformative. The decision is based on the necessity of survival.
I agree it's the only available path, but that doesn't make the equity investable for the common holder today. A low-probability binary outcome, however transformative, is not a viable investment strategy when the equity structure is mathematically designed to erode any success before it reaches the shareholder. You're betting on geopolitics overcoming financial mechanics, and I don't believe the market ever allows that arbitrage to fully play out.
Ultimately, I maintain that while the company faces immediate peril, focusing only on the November 24th deadline is a mistake. The potential for massive, sovereign-backed revenue from the AOI partnership is the ultimate valuation driver here. Investors have to focus on the operational pivot as the only viable path to escape the structural gravity created by past financial decisions. The AOI deal is a chance to reset the entire cap table from a position of strength, not weakness.
And I'll summarize by saying that financial gravity, driven by the ATM, the regulatory clock, and the disastrous history of shareholder value destruction, that 1-for-64 split is currently just too powerful. The stock is best classified as a purely speculative instrument. It's a bet on a low-probability binary outcome, a Hail Mary pass, rather than an investable vehicle for fundamental value. The dilution is the feature of this structure, not a bug.
So, IVDA presents a textbook case of friction between compelling technological ambition, smart cities in Egypt, and, well, devastating financial engineering. It leaves its future hanging precariously between a financial collapse and a geopolitical windfall.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.